Good morning, good afternoon from wherever you are. Thank you for joining us today. We are just going to wait about 30 seconds before we get going. All right, let's do it. Thank you for joining us today. We have great attendance, so clearly a lot of interest in this subject. Today's webinar topic is key financial metrics every nonprofit should track for long-term success. A little bit about what you will learn today and what we will cover. We're going to start with an introduction, talk current state of the sector and why all of this matters right now. We'll talk about what to track and how to track it, really the KPIs that matter. We've broken this down into, at a high level, a few different sections. So liquidity KPIs, as we're referring to them as, transparency KPIs, and revenue, health, and resilience KPIs. We'll then go a little bit deeper and show you what these KPIs can look like in real life with some data. We'll then talk fractional CFO services, and we do have some resources at the end that we will provide you access to help you navigate finance in 2026. A little bit about myself. For those of you that don't know me, my name is Omar Visram. I am the co-founder and CEO of Ankle. I started Ankle just over 10 years ago. We just turned 10 recently. Prior to starting Ankle, I spent most of my career in public accounting at KPMG, where I worked in Canadian corporate tax planning and assurance. It's really at KPMG and through a history of working in my family's businesses where I found that smaller organizations really struggle to get a handle on their finances. That really all became the inspiration for Ankle. A little bit about Ankle. As I mentioned, I co-founded Ankle in 2016. My co-founder and I really came together around this idea that you can't build a great organization without good books. That remains at the core of everything that we do today. Today, we serve hundreds of not-for-profits, including many member-based associations, charities, government-funded not-for-profits, a pretty broad group within the not-for-profit sector. We really think of our business as two distinct teams. One is our financial operations team, which offers bookkeeping, payroll, all of the transactional processing that happens throughout the year, and also strategic guidance being the other side of the business, which is fractional controllership and CFO services. I would like to acknowledge that Ankle's head office, where I'm located today, is situated on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh nations. Further, I want to mention that we're grateful to live and work on these lands and recognize our responsibility to learn from and respect the Indigenous communities whose stewardship continues today. At Ankle, we are committed to ongoing reflection and learning as part of our journey toward reconciliation. Just one more point on Ankle before I continue. I would like to mention that we are SOC 2 certified. Our systems and processes are audited every year to demonstrate that we are holding your data to the highest standards from a privacy and compliance perspective. I also just want to mention before I continue that I do have a cold, so I may pause here and there. You may see my screen go black for a second or two. I may just have to escape to blow my nose, so I apologize in advance for that. A little bit more about Ankle and what makes Ankle different. I have a lot of conversations with not-for-profits across the country that ask me how Ankle is different from other options that they might have. And I understand that making a change to an organization like Ankle might be a big decision for you. Ultimately, it comes down to these few items that I have on the screen here today. So, specialized nonprofit expertise. We recognized early on that not-for-profit accounting is very different from for-profit accounting. The accounting standards for not-for-profit organizations are not like are unique. They're definitely unique. And we've developed an in-house training program so that our people, everybody that works in our not-for-profit group, is specially trained on these standards. We also really strive to ensure that your books are audit ready all the time. We have an internal audit level review process that occurs at Ankle Ultimately, this has been developed over a number of years, but we're able to ensure that your books are held to that audit standard throughout the year through these audits that occur on an ongoing basis. And finally, technology and process excellence. So our systems and workflows are really built for nonprofit leaders and boards. We have carefully curated these processes over the years by taking feedback from various stakeholders in not-for-profit organizations to really develop something that is uniquely built for the not-for-profit sector. Carrying on here, this section is called Building Financial Resilience. And I want to just spend a little bit of time, even though today's session is really not about bookkeeping, but really helping to clarify why bookkeeping is such an important foundation for all that we're going to talk about today. Ultimately, in a climate of funding volatility, wage pressure, and heightened scrutiny, clean, real-time financial data is your most strategic asset. Clean books will help you understand how to diversify revenue streams with confidence. It is the foundation for forecasting activity and understanding how to build cash reserves. It can help you demonstrate financial transparency to funders and prove liquidity. Ultimately, without good bookkeeping, everything that we're talking about today will not be possible. So it really is foundational. And again, not to spend too much time on this, but leveraging great accounting technology is important to being able to maintain high quality records and to be able to have timely bookkeeping. So you have probably heard me talking about these tools before if you've ever attended our webinars in the past. QuickBooks Online, Dext, Pluto, Xero. These are all really important tools to the technology ecosystem here at Ankle, and I believe that they deliver great value to not-for-profits. So I would strongly suggest if you're not using these tools today that you look into using them. Please feel free to reach out to us. We'd be happy to talk to you about them further. Let's dive into where we are today, what the 2026 landscape looks like. So ultimately, the sector is undergoing pressure from various different aspects. One, donor fatigue. So the high cost of living and poor economic conditions are really driving down donations. At the same time, organizations are seeing rising demand. Economic strain is putting increased demand on social and community services, for instance. And then funding volatility. Government grants are facing delays, cuts, and heavier reporting requirements. So really, it is, as we might say, the perfect storm for the not-for-profit sector right now. Compounding all of this, there are factors that are making this worse. We are in a talent crisis. There is wage inflation. We have, since the pandemic, really seen upward pressure on salaries. There is a growing need for senior level financial leadership. We understand that. And of course, cybersecurity and digital risks are at the forefront. NPOs hold sensitive donor data and have been the target of cyber attacks. Also, compliance requirements and being in compliance with various frameworks is important, particularly as technology continues to evolve. And there is heightened scrutiny and compliance. Just a few here: expanded T1044 filing requirements that come into effect in 2026. Really, the new CRA rules increase compliance burdens requiring meticulous financial record keeping. Impact reporting: funders are demanding measurable evidence of impact, linking financial inputs to mission. And audit readiness. Financial reporting must be audit ready year-round, not just at year-end. We are seeing increased pressure from audit firms requiring books to be submitted at a much more complete level than perhaps firms would have expected or accepted in the past. Now let's dive into the KPIs that matter. So why do KPIs matter? Well, one, they help to demonstrate and ensure longevity and sustainability. They help to demonstrate that you are maximizing impact with the funds that you raise. Trust is a critical aspect here, demonstrating financial stewardship and transparency, and also demonstrating efficiency and effectiveness. The reasons may vary depending on the nature of the work that you do and your mission. Here are a few that I think are very important right now. These are what I would call liquidity KPIs. These KPIs can help you very quickly demonstrate and understand whether you can weather the storm. So on the left here, we have the operating reserve ratio, understanding the number of months of expenses that can be covered by unrestricted net assets. We are advising our clients to try to maintain this reserve at between 3 and 6 months. Also, the current ratio, this can simply be calculated by looking at your current assets versus your current liabilities. If you are above 1, that indicates that you are effectively solvent and will be able to cover your short-term obligations. We are seeing a growing number of organizations below 1. So this can be determined very quickly by looking at your balance sheet, assuming that it's been reconciled recently. And then days cash on hand. How many days can you operate on the available cash alone? This can help you understand, if there's a sudden shock to funding, how much cash do you have to sustain operations as they are? And then financial transparency KPIs. So these KPIs really help you communicate your financial position clearly to boards, funders, and various stakeholders. So we have the program expense ratio, which is the percentage of total expenses spent directly on programs versus admin. We have the fundraising efficiency ratio, the cost to raise $1, showing donors how their contributions are being used and if those contributions are being used wisely. And then there are cost per outcome metrics, so linking financial inputs to measurable mission impact, what funders are increasingly looking for. And finally, I'll just cover revenue health and resilience KPIs. So these might help you understand your overall risk profile or at least start to build a bit of a story there. So revenue concentration, if one funder represents, let's say, over 25% of your revenue, you may be vulnerable. This can help you track diversification on a monthly, quarterly, or annual basis. There's donor retention rate. Retaining donors, of course, is far less costly than acquiring new ones. A declining rate may signal stewardship gaps. And then we have your fundraising pipeline. And my recommendation here would be to make sure that you maintain a very clean pipeline and understand what you have committed and what is projected. And then your administrative cost ratio, typically we see between 10 and 15% being healthy, but of course, context does matter. Now let's get into some of the details and actually apply some numbers to these KPIs. Let's first talk about the operating reserve ratio. So what is it? Well, the operating reserve ratio shows unrestricted net assets compared to average monthly expenses. This matters because it helps to ensure and to demonstrate financial sustainability and crisis preparedness. It can tell you how long we might be able to sustain operations without new revenue, for instance. And are we prepared for financial uncertainty? You might want to look at this on a quarterly basis or an annual basis, but especially during budget planning and after major expenses. The data required to calculate the operating reserve ratio should be available from your accounting software. Now, here is a real-life example. Of course, as a reminder, the operating reserve ratio shows you unrestricted net assets divided by average monthly expenses. So let's assume that the average monthly expenses are $96,965. Unrestricted net assets on the balance sheet are $169,622. This demonstrates an operating reserve ratio of 1.7. And this shows that the organization is able to cover just less than 2 months of expenses with its unrestricted net assets. Now, you might be able to use this as a discussion point. Is this sufficient given the current environment? Is this sufficient for your organization given the type of work that you do, or perhaps seasonal fluctuations? Then we have the program efficiency ratio. So what is it? Well, it is program expenses divided by total expenses. This ratio will help you demonstrate how effectively your not-for-profit is using its resources to achieve its mission. It's often scrutinized by donors and stakeholders, and I will say it is often compared one organization to the other to evaluate efficiency. It helps to answer the questions, are we prioritizing programs over administration? Are we efficiently delivering on our mission? You might want to look at it annually or include it in donor reports. You can access it again through your financial statements. To give you an example here, and this, of course, has been created in some software that I will talk about at the end, but assume program expenses of $1,032,362 and total expenses of $1,239,000. This would indicate a program efficiency ratio of 83.3%. Our conclusion here is that a significant portion of the organization's expenses are related to the delivery of its program, which would be viewed positively by stakeholders. Let's talk fundraising efficiency. So this is fundraising expenses over fundraising revenues. This will help you evaluate how cost-effective your fundraising efforts are, and of course that impacts donor confidence. You can look at this at a macro level, organization-wise, or you could look at this on specific fundraising initiatives. It will help you answer questions like, are we raising funds efficiently? Are our fundraising methods worth the investment? You might look at this after each major fundraising campaign or annually for a big picture view, of course, if you're looking at the macro, as I was explaining. You can access the information from fundraising reports from your CRM and from your accounting software. This is what it might look like. So assuming fundraising expenses of $75,000 and fundraising revenues of $152,000, the fundraising efficiency ratio is 0.49 or 49%. This means the costs of the fundraising event are high in relation to the revenues raised. So again, look at this at a macro level, but also look at it on a specific campaign level, because that might help you understand which programs to keep and which to cut. Then we have revenue diversification. In this environment, we are having a lot of conversations with clients about diversifying revenue streams to build resilience. Of course, the goal is to not be overly dependent on one revenue stream. You might want to look at it annually and when reviewing financial strategy or planning for future growth. What questions might it help you answer? Well, one, it might help you answer, are we reliant on one source of income? How diversified are our funding sources? You can generally access this information from your financial statements, since it's usually a function of revenue, the revenue accounts. And of course, we can help you put this together in a view that looks something like this. This one here suggests that this organization is heavily concentrated with one funding source, which may be problematic. Now let's talk unrestricted net assets. So we covered this a little bit earlier, but what unrestricted net assets is really total assets minus total liabilities, minus externally restricted net assets and permanently restricted net assets. That's a very comprehensive definition. So why does it matter? It represents financial flexibility, funds that you can use for operations without restrictions from donors. So what questions might it help you answer? It might help you answer, do we have the flexibility to cover unexpected costs? How much of our revenue is unrestricted? You might look at it during budgeting periods or when doing strategic planning. All of this information should be available to you from your balance sheet. So as long as your balance sheet is up to date and reconciled, you should be able to run this calculation. And here's a visualization of what it might look like. Ultimately, unrestricted net assets for the current year are 169,622. Unrestricted net assets for the prior year were 9,207. This has increased by $160,000, indicating that a significant improvement over the prior year. Next, we have our contribution to fixed expenses. So this demonstrates fixed expenses divided by total revenue. This can help you understand whether you're covering essential costs, your rent, your salaries, your administrative overhead. It may start to lead you towards questions like, do we need to be more nimble? Do we need all of these fixed costs? So when you might want to look at it, you might want to look at it monthly or during financial review periods, again, during budgeting season, perhaps. You can access it through a breakdown of your statement of operations, also known as your income statement. We can help you look at this and understand cost allocation strategies to ensure that fixed expenses are properly covered. This is a visualization of contribution to fixed expenses. So this organization has, on an annual basis, about $750,000 of fixed expenses with total revenues of just under 1.4 million, indicating a contribution to fixed expenses of 53.6%. The organization ultimately has sufficient revenues to cover its fixed costs and ultimately can be agile enough to pursue new opportunities and programs. Of course, all of these ratios need to be evaluated in context. If there are significant concerns coming up ahead around revenue, maybe revenue is expected to decline, maybe your conclusion would be different here. And then the administrative cost ratio, which is the administrative expenses divided by total expenses. Why it matters, ultimately, it helps you ensure a balance between operational efficiency and maintaining a functional administrative structure. It can help to answer questions like, are we spending too much on administration? How can we optimize our administrative expenses? You can look at this annually when reviewing financial performance or preparing reports for stakeholders. This information can be generated from your statement of operations or your income statement. See here. Donor retention rate example here, we would have the number of repeat donors divided by total donors from the previous period. In this situation, there were 500 donors in 2024, and the number of repeat donors were 500 over total donors of 650, indicating a donor retention rate of 77%. The conclusion here is that the organization has successfully retained 75% of its donor base. Now, you may look at this over a few years to understand whether this is good, whether this is not. But of course, as I mentioned earlier, the cost of retaining donors is much lower than acquiring new ones. Oops, I think I have gone a little bit in circles there. We've already covered this one. Yes, we have. Sorry about that. Now let's dive into a little bit more about Ankle and how we might be able to support you. But first, want to spend a little bit of time talking about why many organizations are choosing to go fractional. So as we meet with a lot of organizations across the sector, there is a lot of discussion around how to remain nimble and how to really get the best of what you need for your organization. Ultimately, fractional services can be cost effective. You get financial leadership at a fraction of the cost of a full-time hire. 80% of the results with 20% of the time is how it often lands. These services can be flexible and scalable. Services can be scaled up or scaled down to match your organization's changing needs. You can obtain strategic guidance. So you can get access to high-level advice on financial strategy, cash flow, and long-term planning that wouldn't otherwise be accessible to you if you were required to have somebody, let's say, on your payroll on a full-time basis. It can provide you with broad experience. Not-for-profits, big and small, do have varying needs, and fractional services can provide you with just the right amount of what you need to drive your mission forward. Accurate reporting and compliance. The compliance burdens are increasing. Having the right level of fractional support can help you ensure reliable financials and audit readiness. And ultimately, it can help you focus on growth and mission impact, freeing you up to concentrate on your core business or operation. A lot of what we covered today is really included in our fractional CFO services. So I just wanted to spend a little bit of time here. Our fractional CFOs spend a lot of time helping our clients understand their numbers and how they can use those numbers to make impactful change in their organization. Specifically, fractional CFO can help you with strategic planning, building multi-year financial planning that is aligned with organizational strategy and growth objectives, cash flow planning, building rolling 12-month forecasts, anticipating funding gaps and opportunities, scenario analysis. A lot of organizations today, just given the funding environment, are building multiple different scenarios of what might happen over the next 12 to 18 months. Fractional CFO services can also provide you with a true picture of where you are, monthly budget versus actual reporting, with a forecast to year end, with KPIs like what we went through today, KPIs that tell the full story. Fractional CFOs can help you with board presentations. They can even attend virtually your board meetings and help you understand risks that the organization faces through a risk register. I'm going to show you here what all of this might look like. The KPIs that we reviewed today are often compiled into a report like this that has some high-level summary information about the organization and its finances, variances for the period, a condensed view of the profit and loss or statement of operations, some different views on the balance sheet. This is some cash flow KPIs that might be of interest. That revenue diversification view that we looked at earlier, contribution to fixed expenses with some explanation, fundraising efficiency. So this is the type of information that you can start to receive on, let's say, a monthly or quarterly basis if you engage Ankle for fractional CFO services. Going to keep going here, just a couple more slides before we get to our Q&A. So if you are interested in learning more about our services, please contact us either through this QR code. You can also contact us through our website. We would love to meet with you for 30 minutes for an introductory call to do a bit of current state assessment, where you are today, where your financial operations are, doing a bit of a gap analysis and help you understand how our services might help you either on the financial operations side or the financial management side. We can do a bit of a technology review, helping you understand, what might be possible with your current environment, what the migration plan might look like to a more optimal technology stack. And we can start to give you some high-level recommendations and views on what services might cost. We also have compiled this ebook here called Nonprofit Financial 2026 Guide. We know that it is a tough road ahead for not-for-profits out there, so we've put this guide together to help you navigate 2026. Let's dive into our Q&A here. I'm going to go full screen, so I'm going to turn off the deck here. All right. Let's get into some questions here. Just going to see which order to tackle these in. What platform is best to track KPIs? Excel from QuickBooks Online. Actually, that's a good question, and I didn't mention that. There's a couple of platforms that we really like that plug into QuickBooks Online and 0. And so you can have a look at these Spotlight. So the report that you saw was actually prepared in a tool called Spotlight. There's another one that we really like that is called Sift. And Sift actually can make your data interactive, which can really help you understand what different outcomes might look like as the numbers change. With regards to the fundraising ratio, my concern is that some of the expenses incurred today may not bring immediate returns. Should we still conclude that the fundraising expenses are higher than revenue, so the fundraising is not cost effective? And I'm really glad that this question was asked because ultimately context matters, right? So you might want to actually present two views of the fundraising ratio. The expenses that are really viewed as investment in future outcomes, and those that really did lead to outcomes in the current period. That's where going one layer deeper and looking at specific campaigns might be wise. So, your gala for this year, what were the expenses attributable to that gala? And what was the outcome of that gala in terms of revenue? So I think taking it one layer deeper and also keeping in mind that context matters is the right way to approach this. And then the next question here, do you provide short-term consulting for finance directors rather than long-term fractional contract? Yes, absolutely. So if there is something that you would like to look at on a short-term basis, just to give you some examples, we do board training, we do one-time review of your financial statements to help you look at the KPIs that I went through, for instance, just on an annual basis. We can help you with finance policy. So yes, please feel free to reach out. We'd be happy to talk to you about what we can do even on a one-time project basis. Is a fractional CFO useful when in between hiring for a CFO, or is it a longer-term commitment? Again, I would say it's worth a conversation, and yes, it can work on an interim basis. It may also be the case that you might find that, we can realign tasks and duties, and, perhaps fractional CFO might even be sustainable over a longer period of time. But yes, happy to have a conversation about this. Of the KPIs you spoke about today, is there one you see as most important in understanding organizational health? It's actually, to be honest with you, it's those ones that I put up at the beginning, particularly around your fixed ass or sorry, your short-term assets versus your short-term liabilities. This is the one that I think every organization needs to be looking at today. And, if you are in a troubling situation, if you're below one, start asking questions. Share this information with your stakeholders because it is a sign that potentially there are challenges on the horizon for you. So I would say really looking at your short-term liquidity would be the most important one to look at. Again, I will say this caveat that, of course, context matters. There's a bunch of others here. When assessing our cost structure, what's considered a healthy and sustainable allocation of expenses for a nonprofit between program expenses, administrative costs, fundraising, and any other key categories we should be tracking? This is a really tough one. I'd say context specific. I did share some indication of what we generally say and see throughout the presentation. But I would say to get really specific on your organization, the context really does matter. Okay. There are others here. I think I am going to end it here, however. Many of these are, actually, I see a number of these are repeated from other questions. But I would encourage you to reach out to us, again, through that QR code that we shared or through our website if you would like to, speak further about how we might be able to support you and, how we might be able to help you bring some financial data together for your organization. Again, thank you so much for taking time out of your busy schedule to be here. I know that as leaders in the nonprofit sector, you are pulled in many different directions. So again, thank you so much. Have a wonderful day.